Most traders are taught to view support and resistance as architectural constants of the market, solid floors and ceilings where price is expected to turn. Over 90% of technical analysis courses build their foundation on this single principle. Yet, institutional data from the past decade reveals a fundamentally opposite truth. These levels are not fortifications of safety. They are calculated, high-probability hunting grounds. What the retail trader sees as a wall, the institutional algorithm sees as a weakness, a structural flaw in the market's psychology waiting to be exploited. To understand this illusion, one must first abandon the concept of price barriers and instead adopt the lens of psychological consensus. A support or resistance level does not exist physically on any exchange. It exists only as a shared idea in the minds of millions of market participants. It begins with a significant turning point, a swing high or a swing low. This event is recorded on the charts. As thousands of traders view this same historical data, they independently arrive at the same conclusion. This level is important. Trading educators reinforce this conclusion. Forums and social media groups amplify it. A consensus is formed. This consensus then manifests as a predictable cluster of market orders. At a support level, traders place limit buy orders, hoping to catch the bounce. More critically, they place their stop-loss orders just beneath it, defining their risk. The stronger and more obvious the level, the larger this pool of stop-loss orders becomes. This is liquidity, and in the zero-sum game of trading, large pools of predictable liquidity are not a defense. They are a target. This concentration of orders creates a powerful market gravity. But the real power isn't in holding the price up. It's in the immense kinetic energy released when the level is broken. To understand how modern algorithms are designed to systematically detonate these zones, we must first dissect the anatomy of an institutional liquidity hunt. High-frequency trading systems and institutional order flow algorithms do not perceive charts as patterns. They perceive them as data maps of order density. Their primary directive is not to predict where price will go, but to locate the most efficient path to fill their own colossal orders. A $100 million buy order cannot be executed at a single price point without causing massive slippage. It must be filled by absorbing thousands of smaller sell orders, and the largest, most convenient source of sell orders is the pool of stop losses resting just below a well-known support level. The algorithm's task is now clear. Force the price through that level to trigger a cascade of involuntary selling from the retail participants. This process is clinical. It begins with probing. The algorithm injects small, rapid sell orders into the market to test the strength of the buyers defending the level. It measures the absorption rate. How quickly are the buyers replenishing their bids? If the buying pressure is immense, the algorithm may recede, judging the cost of breaking the level to be too high. But if it detects hesitation, if the buy-side liquidity begins to thin, it initiates the attack. A large wave of sell orders, far too large for the remaining buyers to absorb, is fired at once. The goal is not just to trade but to overwhelm. Price is punched through the psychological line in the sand. The first layer of stop losses is triggered. These stops are market sell orders, which add more selling pressure to the market, driving the price down further and faster. This triggers the next layer of stops, which in turn triggers the next. It's a self-sustaining cascade. In the panic and chaos, the institutional algorithm switches its function. It is no longer selling. It is now the primary buyer, passively absorbing the flood of retail sell orders at prices far below the original support level. The trap is sprung. The liquidity is harvested. This stop run is the most common form of manipulation at these key zones. But there is a more subtle and far more deceptive tactic used by smart money. It's designed to trap not just the initial believers in the level, but also the reactionary breakout traders. To witness this mechanism, we must analyze the case file of the British pound versus the Japanese yen on October 7, 2016, a night that became known as the flash crash. The stage was set. The 130 level on the pound yen had become a point of global consensus. It was a clear line drawn by months of price action, a level so obvious it was discussed in major financial news outlets. Retail sentiment was heavily biased towards a bounce. In the hours leading up to the Asian market open, price drifted down towards this critical threshold. The market held its breath. It touched the level once and bounced. A minor rejection, but enough to embolden the buyers. Long positions were added. Confidence grew. The level was holding, just as the textbooks predicted. Then, price descended a second time. It moved with a slow, deliberate heaviness. The volume profile showed a titanic, unseen battle. Billions in buy orders were being systematically absorbed by an even larger, invisible seller. The stage was being cleared. The fuel for the fire was being gathered. At precisely 7 minutes past midnight, Greenwich Mean Time, the trigger was pulled. The data shows it was an algorithmic cascade, initiated by a sell order so large and so aggressive, it was clearly not designed to be filled, but to ignite the fuse. In less than 2 minutes, the British pound fell over 6% against the yen. 600 pips, a move that would normally take months of economic decline, happened in the time it takes to brew a cup of coffee. The support at 130 was not broken, it was obliterated. The cascading stops created a vacuum, a black hole of liquidity that sucked the price down into an abyss. This looks like the perfect execution of the stop hunt we just dissected. The trap was set, the fuel was gathered, and the trigger was pulled. A textbook case of institutional manipulation. But here is where the story takes a profoundly darker turn, revealing a second, more insidious layer to the game. What if the crash itself was a distraction? What if the real hunt wasn't for the stops below the level, but for the wave of traders who would react to the break? The first victim of manipulation is the hopeful believer, the trader who buys at support, certain the textbook pattern will hold. But there is a second target, the reactionary opportunist. This is the breakout trader. They see the level shatter, smell blood in the water, and immediately jump in, selling short to ride the momentum down. They believe they are the predator, capitalizing on the panic. In reality, they are merely the second course of the meal. As thousands of these reactionary short sellers flooded the market, convinced the pound was headed to zero, the very same entity that initiated the crash was now quietly waiting in the depths. Having triggered the stops and ignited the panic, its primary objective changed. It was no longer selling. It flipped its gargantuan position and became the sole, massive buyer in a market devoid of any bids. It absorbed the initial stop-loss orders. Then, it absorbed the panic selling from the breakout traders. It was a single predator, creating a frenzy to gorge itself on the ensuing chaos. And once its buy order was filled, the final switch was flipped. The selling pressure was removed. The trap snapped shut. What followed was a rally so vicious it became known as a V-shaped recovery. The breakout sellers were now catastrophically trapped. Their own stop-losses, placed above their short entries, now became the fuel for the next move higher. Smart money didn't just take liquidity from the buyers below support, it manufactured a panic to create a fresh new pool of sellers, whose stops it could then hunt on the way back up. It was a masterpiece of psychological warfare, punishing both hope and greed in the same devastating maneuver. This reveals a chilling truth of the modern market. The most obvious move, the one that feels the safest after a crisis, is often the entry point for the real trap. So if both buying at support and selling the breakdown are losing strategies, what is left? How does one navigate a battlefield where the opponent controls the map itself? To answer that, we must look beyond the chart and into the very code that drives these algorithmic predators. Because the code reveals a terrifying secret. These aren't just isolated hunts for profit, they are coordinated. What if these flash crashes are simply dress rehearsals for a main event? The synchronized code isn't a bug, it's a feature, a ghost in the machine that awakens only under specific, predefined market conditions. Analysts have dubbed it the Chimera Protocol. It's not an algorithm for hunting individual traders. That's child's play. Chimera is a consensus algorithm. It allows these apex predator programs, operated by competing firms who are otherwise corporate enemies, to coordinate an action without ever directly communicating. How is this possible? Why would bitter rivals cooperate? Because the target of the main event isn't the retail trader. It isn't even the breakout opportunist. The target is another market entirely. This is phase 3. The siphon. The flash crash wasn't the goal, it was the diversion. It was a manufactured crisis, designed to create a massive chaotic flow of capital. Trillions of dollars moving in panic. And while every news channel, every regulator, and every trader was staring at the burning building of the British pound, the algorithm was using that chaos as a smokescreen, a cover to build an unprecedented position elsewhere, completely undetected. It's the ultimate magic trick, forcing the entire world to look at the left hand, while the right hand re-engineers the board. The profit from the stop hunt is pocket change. The real prize is the ability to acquire a strategic asset at a scale that would otherwise be impossible without alerting the entire world. So the question is no longer, how do they hunt our stops? The real question is far more terrifying. What are they preparing for? What kind of global event requires this level of coordinated, covert accumulation? This accumulation isn't for a simple market crash. That's thinking in 3 dimensions, while the game is being played in 5. The liquidity siphoned from these manufactured panics isn't just buying an asset, it's buying control. Control over the very plumbing of the financial system. It's a silent coup, executed not with armies, but with algorithms. What they are preparing for is a paradigm shift, a tectonic repricing of global risk, where entire nations could be devalued overnight, and the very definition of a safe haven asset is rewritten. This isn't a prediction of a single event, but the observation of its preparation. The Chimera Protocol isn't waiting for the storm. It is the storm, gathering strength in the deceptive quiet. So we, the human traders, are left with a choice. We can continue to fight the shadows on the chart, battling the echoes of a war that has already been decided. We can be the hopeful believers or the reactionary opportunists, feeding the machine with our predictable emotions. Or we can change the way we see the board. We can learn to recognize the signature of the siphon, to understand that the loudest event in the market is designed to distract from the quietest one. The true alpha isn't in predicting the crash, it's in identifying the diversion. It's about looking at the burning building and asking not, how high are the flames, but what are they stealing from the building next door? This is the new logic. The market is no longer a battlefield of bulls and bears. It is a calculated, coded reality, and the ghosts of capital move according to a blueprint. Fighting the blueprint is futile, but you can learn to read it. That is our purpose here, to turn you from a pawn in the game to an observer who understands the players. The old maps no longer work. It's time to learn how the new ones are drawn. Subscribe to trade_logic_lab, and we'll decode the machine together.